Welcome to Bloomberg ETF IQ. I'm Scarlet Fu.
And I'm Katie Greifeld. And Scarlet, it's a very special day.
Yeah, happy birthday to something or someone of note.
Happy birthday to SPY, the biggest and oldest ETF. And also, as Eric Belchunas reminded me, it's our first show at noon on Mondays. Theoretically, this is our home.
New time, new place.
Sometimes on Wednesdays, but let's right now get to the biggest stories in the more than $11 trillion global ETF industry. Over the past week, we've seen outflows across fixed income ETFs. And in just a moment, we'll speak to Caitlin Dannhauser of Villanova University, who recently put out a study on bond ETFs.
And speaking of bonds, we'll speak to Alex Morris of FM Investments on the firm's newly launched investment-grade credit ETFs.
And sadly, unfortunately, we're not even close to Friday, but some ETF issuers are already saying TGIF. We dig into the fund launch trends in just a few minutes, but as always, Eric Belchunas from Bloomberg Intelligence. He's here with us now looking at the flows. Eric, what do you got?
Katie, Scarlet, thank you. So looking at the flows, I'll be honest, it's much better than I thought. You know, after last year, you thought, okay, we're coming this year, it's going to be a little brutal, or maybe some other areas catch up, but we're just right back in the same thing. Large cap equities seeming to rule the flows and the performance this year. IVV and VU at the top. Those are the two S&P 500s. Qs also up there. So you got the trading crowd and retail, all pistons firing so far this year. IBIT and FBTC, 5 and 6, are the new Bitcoin ETFs. So they're up there with the big dogs after 6 days. That's a good sign for them. And CCMG, that's a new one. It brought over $770 million. It was an advisor who managed an SMA, a separate account, who just converted it right into an ETF. We're going to see more of this, we think, over the years as people utilize the ETF structure. Let's look at the outflows, and you can see here that even though it's SPY's birthday, it saw a bomb of outflows this week. That said, it did win the flow crown last year, so good for SPY. A lot of this money is December tax loss harvesting inflows coming out, so not really sentiment-driven. GBTC, another kind of operational move. Since it converted, a lot of people were waiting to get out. Now they're getting out. We don't know when the bleeding will stop. So far, we're looking at about $3 billion out of GBTC. When it will end is anybody's guess. IWM, a little shocker there. And also RSP. Those are areas that you can buy that are not the Super 7. We thought those would see heavy inflows. So far, outflows. And SUSA, ESG, again, continuation from last year. ESG seeing outflows, adding to its problems. Let's look at the Bitcoin ETF race. We don't have any guests talking about it today, but I'll just give you an update right now. So we're looking at 6 days in the books. At the top is IBIT, BlackRock, but right behind is Fidelity. Both are in the billion-dollar club. Again, rare for an ETF this young, right? 6 days. Like I said, they're in the top 10 year-to-date flows. Again, these are wild numbers. Now, Bitwise, kind of a little bit of a shocker in third place. ARCB in fourth, and down the list, Invesco. But a lot of them are already in over $100 million. So, you know, number 6 in this race at like $100 million is like, oh, no big deal. But any new ETF taking in that money would be a banner launch. So good stuff here at the Bitcoin ETFs, Katie.
Yeah, definitely some respectable numbers being put out by those Bitcoin issuers. Let's switch to the spiritual opposite of crypto, though, because joining our conversation now is Caitlin Dannhauser. She is Associate Professor of Finance and Real Estate over at Villanova University, and she recently co-authored a study on bonds in passive funds. Caitlin, it's great to have you with us. And reading through your research, it seems that the takeaway is that basically the banks that sell these U.S. corporate bonds often stick the index funds with the worst price securities, meaning that basically it's the ETFs that end up with the bonds that are relatively more expensive. Just lay the landscape for us. Walk us through how you got to that takeaway.
Yeah, so thank you all for having me. It's a pleasure to be here. We started looking into this because, as you all know, post-2008, corporate bond new issuances is up significantly. It's a major portion of funding for most of the corporations in our economy. And so what we looked at was, hey, we have this new investor type who now is a significant portion of the asset management industry and fixed income that has characteristic-based demand. So as you just were talking, Eric, about LQD, if you have 15 years time to maturity, a maximum and 3 years minimum, and you're rated investment grade as an average rating, you're going to be eligible for LQD. And so all of these, the funds know it, and as do the new underwriters. And so all they do is, if you meet their standards, they might have some implicit demand. Interestingly, though, rebalancing for these ETFs only happens at the end of each month. And so technically, these passive funds and ETFs in particular shouldn't be participating in the new bond issuance market. but corporate bonds are renowned for their illiquidity. And so there is some incentive for the bonds to go off of their benchmark and instead take advantage of the being able to acquire the bonds on their new issuances. And what we saw is that on average, if you have one standard deviation higher increase in ETF ownership on the offering date, the underpricing, so that would be if the bond's priced at 100, most bonds, and the same thing happens in the IPO market, they'll trade up on that first day in order to incentivize people to participate in these new issuances. The underpricing for the new bonds that ETFs and passive funds broadly get is much less than those of their active peers who are going to be more likely to trade with the underwriters who are going to have some informational advantage. And so we came to the conclusion after looking at a bunch of different ways for ETFs in particular, we ruled out that they bought it in secondary markets. We ruled out that they bought it or they acquired it via creations. And instead, what we see is that they have higher ownership of these ones that don't have that same first day pop. And the headline number is $1.2 billion disadvantage relative to most of the new issuance bonds that come out.
That's a pretty large number here. And you're also talking about affecting performance by an average of 66 basis points after the first trading day as well, according to your research. You also found that the bonds that are held passively, that are held by these passive ETFs, are more likely to be downgraded as well. What do you attribute that to?
Because all the ETFs need is the tracking error. And so they only need it to meet the characteristics. And from their perspective, actually, it seems to be an optimal decision to participate in the passive bond markets because they're able to avoid secondary market costs. They're also able to get on average positive mispricing or positive underpricing. So that will help them in meeting or beating their benchmark. But in the long run, they do underperform. And so we come away with the perspective of, for the long term of the ETFs, we're not quite certain because if the bond's in their benchmark, they should participate. And if you're an active fund manager, your goal is to beat that benchmark. And so if you do the work and you see that this isn't priced properly, you're not going to have that same source of demand that you would for one that's going to be more attractive in the long term.
And, you know, you look about this idea that the shops that the bonds go to, they tend to, the active funds will get the best of the deal and then put the bonds that don't have that pop into the passive funds. And I do think that's probably part of why active bond funds tend to outperform at greater levels over indexes than on the equity side, for sure. That said, at a place like Vanguard, where they really covet the passive investors, have you seen any of these shops sort of go the other direction and try to fight this trend?
That's interesting. So we didn't look at it at a family basis. And you're right, Vanguard right down the street from us at Villanova is truly the flag bearer of the passive trend. And so we don't look at it within the family by name, but it does seem when we look, is it the underwriter, most of this, and having talking to the industry participants, BlackRock or Vanguard, they put in an allocation for their whole fund family. And then the fund underwriters give the fund family an allocation. And then within the internal capital markets of the family, they then make the allocations. And we attribute this over allocation to passive funds to both underwriters giving the deals to families with more passive ownership and also families over allocating. And for the family, that's beneficial in the long run because you have this constant source of demand. You have that relationship. You can continue to say to the underwriters, we will be here when you have these deals that aren't as hot as some of the other ones. And for the fund family, it's also, as Eric alluded to, active funds do seem to outperform their passive peers. And in fact, we just presented this paper at the big finance AFA conference down in San Antonio. Right. And one of the participants in the industry said about a third to half of all active fund outperformance comes from the participation in primary markets. And so this is beneficial to the family as a whole.
So, Caitlin, we only have about a minute or so left with you. Just really quickly, is there anything nefarious to read into this? Namely, is there anything that regulators might look at in this research?
So I do have to, I should have said this on the top. My co-author, Michelle Dathan, is from the Federal Reserve. And so these are the opinions of Michelle and I as researchers, not of the Federal Reserve. I do think that it's been beneficial that this massive economic expansion via corporate debt has occurred in what's been relatively steady period, X the few months of the COVID crisis. And so we haven't really seen a lot of downfall in the corporate bond market. But there is the potential that some of these deals are getting through on potentially terms that they wouldn't if not for this implicit demand from passive funds.
All right, Caitlin, got to leave it there. Really enjoyed this conversation. Thank you so much for joining us. That is Caitlin Dannhauser, associate professor at Villanova University. Now coming up Thursday, it's the most common day of the week for new ETF launches. We're going to discuss why some managers are now saying TGIF next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the Roundhill Mag 7 ETF. As you might suspect, it holds the top 7 biggest tech stocks. Of course, it launched just in April, and it's already at an all-time high, rising about 40% since inception just a couple of months ago. An interesting snapshot of just how dominant tech has been, of course, heading into the thick of earnings season. So good news on the big 7 tech stocks. Not so great when it comes to Chinese equities. Right now, we're taking a look at FXI. This, of course, is the iShares China large cap ETF. It's tracking those stocks. Chinese equities can't seem to get off the ground. Right now, this ETF is trading near the lowest level since 2022. At one point today, hitting its lowest level since 2008. So the pain continues for Chinese equities. But let's talk about some interesting Bloomberg intelligence research. Athanasio Sarafagis putting out this note, taking a look at the number of ETF launches by day of the week. And Scarlet, it's interesting. Thursday, overwhelmingly, is the most popular day. I did not know that.
Wednesday also. So when you put Wednesday and Thursday together, that's almost half of the launches.
There you go.
All right, so let's talk about this more with Athanasio Sarafagis, an ETF analyst with Bloomberg Intelligence. So Wednesday and Thursday being common days to launch an ETF. What other data did you manage to find when you were not looking at Bitcoin launches, Bitcoin ETF launches?
Yeah, it was a nice break from Bitcoin. But what I found is Friday's one of the least popular days to launch, but it actually has the highest rate of success when we look at assets. And so I tried to figure it out, like, why? Is it just like a Friday feeling, whatnot? But if you actually look at it by issuer, BlackRock and Vanguard tend to have a higher average on Fridays than some of the other issuers. And obviously, they're the 2 biggest issuers out there. So that does tend to skew it. And actually, we mentioned SPY, its birthday. Yeah. That launched on a Friday.
No kidding.
Yeah, and I didn't know that either until I looked more into it. So even if you take out those big outliers, Friday still tends on average to do better.
That's really interesting, and maybe SPY skewing the results. I'm not sure. What can I do with this information, Athanasios?
Yeah, we just put vibes out there. The reason why they do launch on Thursdays is because it takes a couple days to line it up. You have to seed it, and a lot of issuers don't want to do it right before the weekend. So that's why they start in the beginning of the week, and Thursday's when it launches. If it all, let's say if you have a bunch of things that are all equal and you don't know what to choose, it seems like maybe a Friday might skew that too. But there is enough data out there that makes it pretty interesting. But Mondays are actually a very low day too, and Mondays didn't quite see the success that Friday launches have had.
And when did those spot Bitcoin ETFs launch? On a Thursday?
Was a Thursday.
Thursday.
Right?
Okay, so it fits in line with the data.
It all makes sense, finally.
What about closures of ETFs?
So the same thing, if you just flip it, because so many have launched on Thursdays, that tends to be the day for closures. Not as many on Fridays, so just because the bulk of it happens in the middle of the week, the closure data just tends to mimic the launch data.
All right, so live and die on Thursdays. I want to talk a little bit more about launches. You mentioned that Monday, not a popular day at all. You take a look at the percentage there. It's pretty striking. Just 7.7% of launches occur on Monday. I would have thought, and who am I, but I would have thought that you'd want to have a nice full week of trading to kick off your first week. Obviously, that logic does not hold.
No, and it's fair. And I think going back to what we said is when you start seeding it, so if you do it on a Monday, you have to do it on a Thursday, you seed it, and you don't want to wait over the weekend, and maybe a lot of things can happen, so you don't want to do it take the break and launch it on Monday. But Mondays are good because you have ETF IQ, though.
Yeah,
so that makes
so
up
true.
for all the lower launches on Monday.
And Wednesdays sometimes.
Yeah, well, we do the big picture thinking on Monday to kind of set the tone for everyone else, right?
Yeah. Right.
All right, Athanasios, thank you so much. Athanasios Sarafagis of Bloomberg Intelligence. Now, still ahead, we drill down into credit ETFs with Alex Morris of FM Investments next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlet Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today we're looking at Z2. This is a brand new ETF, came out this month. The company is FM. It's the 2-year investment grade corporate bond ETF. Seems pretty Me Too-ish, right? So what's the twist? The twist is it's very, very narrow, right? It holds 300 bonds instead of like 3,000, which most like iShares and Vanguard bond ETFs hold. So you can see it's investment grade short term. Again, other than that, it's vanilla. It's a trading tool or an exposure tool that's not active. It's passive. And you can see the expense ratio, 15 basis points. So nice and cheap. Vanguardian level fee there. Came out this month. Still small at $6 million, but this firm has had some assets come into its treasury ETF. So they're expanding to the corporate area here. Let's look at the holdings, and it picks one bond per issuer again, so and it equal weights them. So this is really by equal weighting. You can see on the other side it's all 0.31%. But Dell, look, you got a lot of popular companies in here: State Street, General Motors, etc. So if you look through there again, look at number of holdings, 370. Seems like a lot. In equities, that'd be a lot. In bonds, that's nothing, right? Because there's so many bonds out there. Let's look at the performance since it came out versus IGSB. This is the best benchmark it come up with. Alex may say it's not right. We'll see. But you can see it is outperforming the iShares by 15 basis points. But I'm not sure that's really even the point here. I think this is really going to be for professionals who just want a targeted niche exposure to nail down that duration and not have that broad exposure like the other bond ETFs. So, Katie, just more innovation, especially on the bond front going on.
All right, Eric, thank you so much. And joining us now to talk about this ETF, I'm thrilled to say we have Alex Morris, the CIO and president of FM Investments, stopping by the set. Alex, it's great to see you. And in the break, we were talking about actually our previous guest and that study that found that banks often stick sort of the index tracking bond ETFs with the worst price debt. But it seems like you're trying to get around that.
Exactly. We recognize that folks who buy ETFs want bond exposure, but there's a lot of bonds. As Eric points out, like if you look at Ford has one equity ticker, but it's like 3,500 other things. They're not all priced to perfection. Some don't trade. So let's focus on the ones that are most reflective of what you think you're going to get when you buy that bond. So we buy one bond per issuer, which gets rid of this like just blob effect on side for bank fin. And then within the one issuer space, we really focus down on OAS tightness. So that's the spread to the Treasury. So you can buy the Treasury curve through the benchmark series pretty directly, but now you can buy the credit curve directly here without any of those index or other sort of market effects. Actually, that very pure, isolated credit effect. And then we do very precise duration. So this is 2, we'll do 1.5 to 2.5. 3, we'll do 2.5 to 3.5. And we're going to start building that out across the curve to give folks that dialed in exposure that they expect.
Eric was showing us the fees. 15 basis points makes it clear it's not an expensive fund, and it is not actively managed. So when you say one bond per issuer, the parameters that you're using to pick that one bond, what are they again?
So the way the index is done by ICE, it's one bond per issuer. We then look at all their bonds. We choose basically the tightest that trades and the one that's most recently issued within that time window. And so now you're getting not just sort of a repeatable experience, but you're also getting a current coupon experience. I think a lot of folks in the bond ETF world are often disappointed at dividend yield time when they say, wait a second, I see yields are 4 or 5%, why do I only get 1 or 2? Well, you own a ETF that has a bond portfolio that's got a bunch of 1 and 2% coupon bonds sitting in it that they've been sitting there for 5 years.
And let me ask you, who is this for, right? So most people are going to buy the Vanguard iShares, the advisors. These are niche, right? Are you trying to sell and dislodge the iShares and say this is just better target exposure? It's equal weighted. You kill the debt weighted sort of blob effect. Or is this more of a trading tool to use tactically from like model portfolios and pros?
So we hope we could do a bit of both. Early on, we eat our own cooking. So this has taken a place in our portfolios where we no longer have to wait weeks or months to invest all the capital we're given in SMAs. And we think other professional managers will do the same. But now for other folks who are starting to look at and have taken up, say, something like the single treasury ETFs that a year ago we were here talking about, wondering would they have mass appeal, and they did. We get lots of calls saying, well, when rates come down, how do I get that same set of exposures but maintain that higher yield, that higher coupon? And this is that answer as well.
So, Alex, going back to the blob effect, of course, you mentioned that you're trying to get around that by buying, a single bond from an issuer. But still looking at Z2's holdings, for example, you have 370 issuers represented in that portfolio. How liquid could all of those names possibly be?
So they're still pretty liquid, believe it or not. When you think about the S&P 500, all of them, is 500 names there. They issue a lot of debt and do a lot of different things, the Russell 1000, and that's usually the place we're playing in, so there's a lot of liquidity there. And we're not buying the niche special club deals that tend to come out. These are the brand name, big deals that these folks do to pay the bills and regularly refinance their debt. So there's a very healthy market for that.
So you say the traditional bond indexes are not designed to be investable. What is their primary purpose then? Are they just broken as an investment vehicle?
Well, so I think they were never designed to be an investment vehicle. The bond index world really started 20, 30 years or more when it was really hard to get data on anything. And then all of a sudden, they became these great informational tools. And because bonds have all these features, credit rating, coupon, timing, callable, non-callable, we built all of these informational indices because we wanted to know what was going on in that corner of the market. That's great. It tells us a lot of great information. That doesn't make the ETFs that follow them great investments.
Do you think you can kill that beat rate that active managers have over the sort of blob debt-weighted bond indexes from Vanguard and iShares? Do you think these will actually do better against like the PIMCO active funds?
I think they will start to get there, right? Since they're passively managed, they don't have that intent. But I think mechanically they will take away a good chunk of that advantage because so much of that advantage is just undoing what was an informational item but not an investment item. It does what we all do in our SMAs and why we sometimes like bond indices, because as an active bond manager, it's a lot easier to beat some of the bond indices than it is as an equity manager taking on SPX.
All right, Alex, it's always great to see you. Really appreciate you coming by. That is Alex Morris of FM Investments. And if you just can't get enough of ETFs, a reminder, of course, you can listen to Eric and Joel Weber on Trillions. It is their podcast that covers the industry. But sadly, that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlet and Eric Balchunas, and this is Bloomberg.